Yes, I think we can start the webinar now. A very good evening to all of you. I think we have around 60 participants, and hope to have more as the session progresses. Very pleased to introduce Saurabh Suparkar once again for the Aurtus webinar. Saurabh, many thanks for again gracing this occasion. We have had a very interesting budget announcement yesterday, as always. Some regulatory announcements, a bit of tweaking on the direct tax side, on the indirect tax side, and as always, we are very pleased to bring a webinar just talking and sharing our thoughts about it. The way we will talk about is, first, we will have a keynote address from Saurabh Bhai. I think Saurabh Bhai doesn't need any introduction. He's a senior counsel, our tax guru, and we are just lucky to have him and get Saurabh Bhai's keynote comments on how he looks at the budget proposals. Thereafter, we will have Rutul speak on the policy announcements, and we will have Zeal starting her views on the direct tax proposals, followed by my participation on some of the slides, and then we will have Chintan who will talk on the indirect tax proposals. We also have a Q&A window, so if any of the participants have any questions, feel free to put in your question, and maybe at the end of the webinar, we can take 10 to 15 minutes and try to address some of the queries. Saurabh Bhai, once again, welcome to the Aurtus webinar, and the stage is yours.
Thank you, Vishal Bhai, and all participants. I'm happy to be here. Yesterday morning, much before the budget was presented on the floor of Parliament, somebody sent to me, I wouldn't use the word a joke, but a prediction. And I'll just read the prediction. And I recollect the same prediction was there even last year, but the prediction was, quote, and I'm quoting, today, Mrs. Nirmala Sitharaman would present budget at 11 a.m. and 11:15 a.m. Arnab Goswami would declare the budget as historic. At 1:15 p.m., Congress would declare budget as a disaster. CPI would declare budget as friendly to Ambani's and Adani's. SP would declare budget as anti-farmer. Other parties would do their
I think there is some. Vishal, can you hear Saurabh Bhai?
No, Saurabh Bhai, I think there is a slight network issue at your end. I will just wait for Saurabh Bhai maybe to reconnect.
Am I there now?
Yes.
I don't know what was stopped. Okay.
Yeah.
Continue the narrative. In the evening, entire media led by A and B would become the top economists of the world. But at night, the common man would go to sleep, wondering as to what difference has been made by this budget as he has to go to work the next day. The issue that I'm trying to make out is when a finance bill is presented on the floor of the on the Lok Sabha by Honorable the Finance Minister, everyone views this document from different perspectives. And depending upon where does the loyalty lie, or where does the thinking goes, a person would hail the budget as most progressive to another person saying it's a disastrous budget. I have no desire to get into the nitty-gritty of the budget because I'm only here to have some very, very broad overview. Because technical aspects of the budget, the finance bill, will be dealt with by the experts who will be speaking hereafter. So let us look at the budget from the perspective of historical background. It is true that the world right now is passing through very, very tough time. The war between Russia and Ukraine has significantly impacted the world economy. There is shortage of oil because of the fact that people have started boycotting Russian oil. Consequently, there is inflation all around. In these circumstances, on account of our close relationship with Russia or otherwise, we have been able to ensure that our financial position is not bad. In fact, it is reasonably good. GDP for the year is expected to be between 6 to 6.6%, which is supposed to be the best or highest in the world, higher than almost any major economy, and much higher than the world average. Tax collection on a year-to-year basis have gone up by 15.5%. GST collections GST collection of January 23 has been the second highest so far, more than ₹1,65,000 crore. Collection of GST is higher by 24.8%. The after effect of coronavirus, by now economy has stabilized. Banking sector has improved. With the cleaning of the balance sheet, the banks have been performing better. Gross NPA rate has fallen down to less than 0.5%, which is 7-year lowest. IBC has now started paying dividends, and on account of the corporate insolvency resolution plans being approved, now the companies are being put back on set in state as early as possible. Obviously, we have a worrying problem of inflation. As against 6% anticipated, we have inflation of 7.8%. But then economy is doing very well. Service sector has gone up to 9.1%. Stock market has continued to maintain 60,000 Sensex since last 1 year in spite of pluses and minuses. I give all positive things. Why did I enumerate? Because in spite of all these positive things, why is it that in the finance bill, you find Honorable the Finance Minister not taking firm steps in a clear direction for the purpose of achieving a long-term goal? We intend to be 5 trillion economy soon. But are there any steps being taken in that direction? Budget ultimately is handiwork of government to showcase to the world and the people of their thinking in the matter of economy. We must not forget the reluctance on the part of the government in bringing about bold measures for the purpose of improving the economy could be significantly on account of political considerations. This year we had 3 elections in which BJP won one Gujarat, lost one Himachal Pradesh, lost municipal election of Delhi. And this year, last year, this was the position last year, this year we are expecting elections in 9 more states. Next year we have got general election. Looking at the popularity of Honorable the Prime Minister in particular, or BJP in general, I do not envisage political upheaval. But at the same time, Honorable Finance Minister may not be very, very keen in this almost the last budget, because next year's budget is not going to be full-fledged budget. It's going to be vote on account, and the final budget will be presented after the elections are, the results of the elections are declared. So maybe the Honorable the Finance Minister played safe, went bits and pieces, made some improvements here and there, has given some benefits, some protections, some advantages, may or may not really be fully meeting the expectations of people. Having said this, again, if you look at the allocation of funds, there is significant emphasis on infrastructure. as against rupees 7.5 lakh crore projected last year. This year it is budgeted to be rupees 10 lakh crore, meaning thereby increase of about 33%. There is a push on consumption. Idea is to see that economy improves as early as possible. To what extent we will be able to do that, only time will tell. Having said this, let me now go to the very briefly 3 or 4 proposals before I hand over the proceedings to Vishal and his team. One thing that this budget is conspicuously vociferous by its absence is non-introduction of the estate duty. Since last more than 10 years, everybody is apprehending, for good, bad, or indifferent reason, that this government will reintroduce estate duty, as a result of which all high net worth individuals will be put to, or their estates will be put to significant amount of duty-based erosion, because death is obviously a certainty. Every year, people have a sigh of relief as and when the finance bill is presented, that there is no introduction of estate duty. So this is certainly an event which is good because of its non-happening. Let's look at very broadly to 3 or 4 amendments which I believe may have some bearing, especially in the matter of the income tax, insofar as business people are concerned. There is obviously increasing the exemption limit from rupees 2.5 lakh to 3 lakh. Slabs are being shifted. Instead of 6 slabs, 5 slabs. They're all peripheral. 2 things which are important. One, for people at the lower strata of economy, till now, if you have income up to rupees 5 lakh, you were not required to pay any tax. Now that limit is being raised to rupees 7 lakh. Similarly, those who have income in excess of rupees 5 crore were liable to pay tax at the maximum marginal rate of almost 43%, because on the maximum marginal rate of 30%, they were liable to pay surcharge at 37.5% plus the education sales, etc., etc. This additional levy or levy at incremental rate of surcharge of 37.5% as opposed to 25% for income up to rupees 5 crore, that is being now equalized to 25%, meaning thereby all those who earn in excess of rupees 5 crore and today pay almost 43% would now be required to pay tax at 39%. It is true that number of people who would be in that slab may not be more than a few thousand. But then 2 things. One, savings in their hand also would be significant. For example, if a person has income of rupees 25 crore and during the current scenario, even good top class CEO may be having salary of rupees 25 crore. In his case, the saving will be as much as rupees 1 crore. So one, there will be a significant saving of tax at the lower level because the exemption limit is raised from rupees 5 lakh to 7 lakh. And at the highest level, when the rate of tax is being reduced from 43% to 39%. So number one, the funds available in the hand of people for the purpose of saving and investment will go up, which might boost the economy. It will also send a signal, and I think it's a positive signal, that this government is not trying to be quote unquote socialist government so as to so much tax the rich so as to bring them down to the level of middle level income persons. They encourage rich people to earn more amount so that they can contribute more to the society. So this is one positive aspect that I must note. Another small but an interesting issue is amendment to section 43B. This is a section which is being introduced by the government for the purpose of introducing checks and balances on payments under various other laws like labor laws, tax laws, etc. Now this provision is being introduced, is being used for the purpose of bringing some kind of control in relation to payment to medium and small enterprises. Look at how the scheme is going to operate. Under the medium and small, micro, small and medium enterprises act. I made a mistake, not medium, but micro. Under MSME Development Act, you are not permitted to have the credit period of more than 45 days. If you have more than 45 days, it will be restricted to 45 days. If you have not entered into any agreement giving credit period specifically, law says by default it is 15 days. The proposed amendment is that any payment that an SSE has to make to MSME would be deductible only in the year in which you have actually made the payment. Therefore, not on accrual basis. Therefore, if you are dealing with a micro enterprise and a small enterprise, please mark to medium enterprise, this amendment does not apply. But if you are dealing with a micro enterprise and a small enterprise, and if at the end of the year, rupees 50 lakh is due and payable to them, and that amount is due and payable to them beyond the period of credit to which you are entitled to, then whole amount of rupees 50 lakh will be disallowed and you will get deduction only in the year in which you make the payment. Unlike other provisions where if you make the payment after the close of the year, before the due date for filing return of income, you still get deduction. For payments to micro and small enterprises, this exception is also not being kept. Therefore, if the payment is due on, let us say, the supply was made on 13th of March, payment is due on March 28. You do not make the payment on March 28, you release the check on 1st April, because of delay of 3 days, you would lose the deduction in year 1, you will get it only in year 2. In a way, this is a benefit which is sought to be given for the purpose of promoting micro and small enterprises. But I wonder, would it really be so beneficial to them? Because it may also be that if people have a choice to deal with micro and small enterprises versus non-micro and small enterprises, the SSEs would say, why should we deal with the former category and run the risk of disallowance of expenditure if we do not make the payment in time? We would rather deal with non-MS entities. More importantly,
I think we have lost Saurabh bhai for a minute. Saurabh bhai, are you able to hear us?
database of every vendor to find out whether it's a it's a small or a micro enterprise. If it is a small or micro enterprise, it will have to keep a watch on a daily basis to ensure that you don't run out of the time to make the payment beyond 31st of March. Having said this, let me now go to the couple of presumptive tax, which is applicable to businessman, where you are permitted to pay tax at 6% or 8%, depending upon whether you have all check payments or not. Today, the limit is rupees 2 crore, which is sought to be raised to rupees 3 crore, provided you don't have cash in excess of rupees 5%. For professional, the limit is 50 lakh, which is raised to rupees 75 lakh. You will be asked to pay tax at 50% of receipt, again provided you do not have cash receipt or exceeding 5%. A good move for the purpose of ensuring that all small businesses, turnover of rupees 3 crore or professional receipt of rupees 75 lakh is not very small. It's a reasonable amount. All those people, if they show income of prescribed percentage or higher, will not have to, in fact, even keep books of account, may not have to suffer any disallowance. The amount that you would save on investment into new house under section 54 on account of sale of one house, or on the sale of non-house, let's say shares, etc., which give rise to capital gain, long-term capital gain. Today there is no ceiling. The provision was being, to some extent, being misused. So now they intend to bring a ceiling of rupees 10 crore, which means if you invest an amount in excess of rupees 10 crore in a new residential house, in excess of rupees 10 crore, benefit of section 54 or 54F would not be available. Market linked debenture, which was so far able to get the benefit of 10% rate of tax, will now be always treated as a short-term asset, will have to pay tax, will suffer tax at full rate. These and there are some other interesting provision, but my job is not to get into the provision of finance bill. What is it that I am looking at now? The bill has as many as 121 amendments only on direct taxes. Some of them so minor, some of them so complex. The whole regime of the charitable trust is sought to be completely realigned. You will require one full day seminar to look into it. I wonder as to whether these kinds of sweeping changes would really create more confusion, or would it create some kind of ease of doing business, which is what is really required at this stage. So let me end this by saying, yes, it's an interesting budget. It's a long budget. If someone were to deal with every clause of the finance bill, person who are organizing, fortunately this is virtual platform, but otherwise persons who are organizing physical seminars may have to arrange at least for the dinner, if not next day's breakfast. But at the end of the day, when I find on a net basis, what I find is there are small steps here, small steps there, but it's not as if there is a big jump from what we have today. And that looking at the pace of the budget, looking at the direction of budget, we'll have something very, very positive to come forward. With this, let me thank all of you for being with me on this opening remarks. I'm sure now Vishal and his team will take over. Thank you very much.
Thanks a lot, Saurabh bhai, for a very well summarized, keynote on the whole budget proposal, etc. Now let me invite my partner Rutul. Rutul will take up the policy announcements, and let me share the screen. Rutul, are you able to see the screen?
Yeah, Vishal. Yes.
Yeah.
Just 1 second.
Yeah.
Hi, good evening, everyone. Thank you, sir, for your opening remarks. Let me talk about the policy announcements. And sir, as Saurabh sir rightly said, the world is going through turbulent times. But the good thing is there is a silver lining for India. And I think so far, India has managed to stay insulated from what is happening outside so far, with all the efforts being put in all directions. And I think the fiscal deficit numbers that we are seeing, 6.4 revised estimate, 5.9 budget estimate, and a target of reaching 4.5, below 4.5 by financial year 25-26 is something that this government is working very hard towards. Of course, there are revisions and then there are unforeseen events, but I think this government over years has been working in this direction, which is a good thing. The finance minister spoke about 7 priorities, and if you look at those priorities, every single priority is something that the country needs today. I think the biggest realization and biggest effort this government is putting in is towards utilizing the demographic potential of this country, which is the people. So when we say India works, people make it work, right? So the government is putting a lot of emphasis on the people-driven initiatives, and that is where the economy has changed the course from investment-driven economy to consumption-driven economy. And there are examples. If we look at old regime versus new regime, the emphasis is to move towards new regime where investments are not really of any significance. There is nothing significant on housing except this affordable housing. There is nothing further on there are no further incentives on investments. And on top of that, we see continuous growth in tax collections, direct taxes as well as indirect taxes, which is nothing but an indication of growing consumption. We see great emphasis on consumption, both on consumer side as well as industrial and greenfield investment side. Look at agriculture investments. This government has also been very focused on agri side. The credit limit this year is capped at 20 lakh crores. And more interestingly, the government has also put emphasis on introducing startups for agri accelerator fund, and bringing young entrepreneurs to bring in a lot of ideas on innovation and affordable solutions for farmers. So I think India, predominantly being an agricultural country, this is a very, very welcome policy move. Infrastructure thrust is phenomenal. 10 lakh crore, 33% increase from last year, 3.3% of GDP is something phenomenal. And a country where the growth trajectory where we stand today, I think this is much needed requirement. Ease of doing business, I think there are some significant steps taken in the direction of ease of doing business. One is PAN is going to be used as a common identifier for all digital systems of specified government agencies. There is this unified filing process which has been introduced, or which is going to be introduced, where common information is going to be shared with various government agencies. But very interestingly, this is as per filer choice. So this is to be distinguished from automatic exchange of information within the departments that take place. So this is something which has been given as a facility to all the assessees. The third point is entity DigiLocker. We all have seen the success of Aadhaar, UPI, DigiLocker, etc. And the idea is to extend the usage of DigiLocker to facilitate secure online storing and sharing of documents within the business ecosystem. I think this is a very, very welcome move. KYC process is also aimed to be simplified by adopting a risk-based approach rather than a single standard approach, which is also, we look at CRS and we look at other common reporting standards. KYC documents are very, very stringent. But if we move to a risk-based approach, then I think a lot of common people, common man, and MSME especially would gain out of this. There are a lot of other developments also which have taken place over the last few years. We look at company incorporation process and spices forms. The company incorporation process has been streamlined and much more efficient, although of course there are challenges with MCA portal. We also look at changes and positive changes on overseas investment regulations, FDI regime, and all these are indicators of the direction that this government is going towards in taking India to next level of growth. There is another point of National Financial Information Registry, which is to be set up in consultation with RBI. The idea here is to act as central repository of financial information and provide facilitation for credit and other credit related facilities. I think sir rightly said IBC was introduced to be a game changer. Of course, it took some time while we could come at that level. But I think RBI working towards this National Financial Information Registry and IBC and NPAs going down, I think we are looking at a much more cleaner and better picture in terms of our credit ecosystem in the country. Gift IFSC, yes, it has been a pet project of our Prime Minister, and every year, with or without budget proposals, we see some of the other developments happening there, whether it is real estate, whether it is fund side, whether it is family office side. And this, again, this budget has also not only on the tech side, but also on the policy side added and has made some announcements. One important announcement here is introduction of single window system for registration and approval from all the relevant authorities and regulators, for example, IFSCA, SEZ, GST, RBI, SEBI, IRDA. And I think more and more we interact with GIFT IFSC authority, more and more we realize that they have a clear mandate of being business friendly, providing required clarification, and to ensure that people start coming there and start doing business from there. Vivad Se Vishwas, we saw Vivad Se Vishwas 1.0. This is Vivad Se Vishwas 2.0, which is more towards settlement of contractual disputes with government and government undertakings. I think we are increasingly seeing that this government is focusing more and more on dispute resolution, reducing disputes, reducing litigation. And while we saw that on the tech side, this on the business side and contractual dispute side is a very, very welcome move on the policy side, because we all know the courts, the judiciary here in India is burdened with so many litigation processes and litigation matters. So I think this is again a welcome move. Last but not the least, again, this is a very interesting policy announcement. I'm sure a lot of the participants would have been a victim of unclaimed shares or unpaid dividends. So this is a welcome move where government has announced an integrated IT portal to allow payment of unpaid dividends and to allow issuance of unclaimed shares to the shareholders. So I think to sum up, there are a lot of interesting policy announcements. The consumption focus has continued, and I think with this, the government has really done well on certain regulatory side, certain business side, and by announcing and by taking up those 7 priority sector and making all the relevant announcements there, I think the government has done a good job there. With that, I'll request my colleague Zeel to take up.
Thanks a lot, Rutul. I think a very well summary of the policy announcements. I think now we have almost 120 participants on the webinar right now, and if there are any FAQs, feel free to drop your questions into the Q&A box. With that, we will jump into the actual tax proposals. So I'll request Zeel to start with the personal taxation.
Hi, good evening, everyone. What I see in the budget to be is something which provides certainty, stability, and efficiency when it comes to compliance and government resolutions. So let me start with one of the most celebrated section in this budget 2023, which is the revamp of the entire tax slabs, which is applicable under the new tax regime. Just to give a little bit of background, the new tax regime was introduced in Finance Act 2020, which provided an alternate slab system with a very reduced deduction availability with respect to computation of an income. There were very few takers of this new tax regime, especially because people did not see any significant advantage when it comes to opting of this new tax regime. And hence it was an option to opt for the new tax regime. In the proposed amendments in budget 2023, the finance minister has said that this new tax regime will now be the default tax regime. So if you want to opt for the old regime, you will have to opt out of the new tax regime. The new tax regime further also revamps the tax slabs which were applicable erstwhile. So now we see 5 different slabs starting from a range of income from 3 lakhs to 6 lakhs. Also, the available rebate, which was there, which was the limit of 5 lakhs, has been revamped to 6 lakhs for the new tax regime. And that is where when a person is earning an income which is up to 7 lakhs of rupees, 7 lakhs. So up to 7 lakhs of rupees, there will not be any tax liability for that individual. The new tax regime also brings certain additional deductions which were earlier not available. So in the earlier tax regime, which was proposed, the deductions which were available were only something which is under 80 JJAA or 80 CCD or an 80 LA. There was no standard deduction available under the new tax regime. Now the government has also proposed a standard deduction of rupees 50,000. There is also a deduction which is available for payment of pension for family pension. And obviously, if there's some contribution to the Agni Veer Corpus Fund for the subscribers of the Agni Veer Fund, then that is also available as a deduction. So when we see at the new tax regime and the proposals which are introduced, like what Saurabh sir said, it caters to the two ends of the spectrum. So we see a host of benefit which is provided to somebody who earns a lower than 7 lakhs of income. And since the new tax regime also revamps the surcharge rate, which will be applicable to somebody at the higher end of the spectrum, which is an income of more than 5 crores, it benefits somebody which is at the other end of the spectrum. The surcharge rate for income over 5 crores, which was erstwhile applicable at the 37% rate, which brought the effective tax rate to 42.74%, has now been reduced, thus bringing the maximum marginal rate for that individual to 39%. So a person who's earning income which is more than 5 crores, obviously that gives him a 3.5 or over 4% of tax cut, and hence is beneficial for him. The interesting bit here is that the finance minister making the new tax regime to be the default tax regime. And that is where there is a clear intention on the, on behalf of the government to say that let's move to a system wherein there are not many tax deductions. The officer does not have to scrutinize the returns to say whether the deductions have been properly claimed or not. It's a standard form, but reducing the tax slabs to make at least the people at the lower end of the strata benefited out of the system, or at least equal to the old system. The important part here is that if you're earning income which is other than income from profits and gains of business and profession, then the individual or the assessee would have the option to opt for the new or the old regime on a year-on-year basis. So it's not that you once opt out of the new regime, you will not be able to opt back. But with respect to taxpayers which are having PGBP income, the option to shift out and come back is restricted only once. So once if the new regime has opted out, you can again go back to new regime, but that is where you will be then continued under the new regime. If we see the effective slab rates for different incomes, for different taxpayers, what comes out is that if you're earning income of less than 7 lakhs as available on the screen, the total tax will be nil. But in the old regime, you still end up paying 7,80,000 rupees, with some presumed deductions which are available under the old regime. But if we see an income which is lower than 7 crores, or 25 lakh of income, then the old regime still works out to be more beneficial than the new regime. And this will obviously depend upon the deductions in form of HRA, ATC, and other exempt perquisites that a person might be otherwise availing under the old regime. But obviously, when you see an income strand which is of say 7 crores or something, then the benefit is again, going to the new regime is more beneficial for the taxpayer. So that is where I think now people below 7 lakhs and more than 5 crores, that comes as an obvious decision. But in between, people will then take a conscious call, work out the deductions which are available, and then carefully select whether to go for the old regime as well as the new regime. The next provision was on to the leave encashment, wherein the limits for leave encashment had been increased, which is available to 3 lakhs to there is an increase of 25 lakhs. That's the limit of exemption for leave encashment. There's just a revision in the number, considering the salaries have increased and the numbers was not kind of updated over the course of time. The next would be the provisions with respect to gift city, the IFSC in the gift city. So the GIFT City as such, and the IFSC, which is the International Financial Service Center in the GIFT City, has been, very much close to heart project of Mr. Modi. Every year we see many amendments which are made in the GIFT IFSC to make it more and more popular. There has been, various sort of amendments during the year provided under the IFSC Act, which includes more and more services and more categories of entities to be, eligible to set up businesses under the IFSC. So now we have not just banks, but we have in financial intermediaries, we have funds, we have family offices, everybody who can set up and take benefit of the IFSC in the GIFT City. One intention was to also have global funds which are operating somewhere, say in Singapore, or operating from a DIFSC in Dubai, to come and set up shop in the GIFT City in India, which is the IFSC in India. And as a corollary to that, there was an exemption was provided for global funds that if they want to relocate from overseas into an IFSC in GIFT City, there will be an exemption which will be given to the fund as well as the unit holders of the fund. The sunset for that exemption was 31st of March 2023. Now that sunset has been extended to 31st of March 2025. Second was typically Category 1 and Category 2 AIFs, which are set up under the SEBI AIF regulations, enjoy a pass-through status. Now, IFSC had come up with IFSCA fund management regulations, and just to accord the same pass-through status to the funds which are set up also under these regulations, there is a clarification which is provided that Category 1 and Category 2 AIFs set up under the IFSCA fund management regulations in the IFSC will also enjoy the same pass-through status. The third was on to the exemption with respect to the income which is distributed by the offshore banking unit on the offshore derivative instruments. So typically, there was always an exemption which was available, to the non-residents on income which is arising on transfer of this instrument, like from when they're holding and when they transfer this instruments, there was always this exemption which was available. However, certain offshore banking units, when they pay income, tax on the income of this ODIs, and when they pass it on to the ODI holders, there was a double taxation which was, being levied. First, at the offshore banking unit level, when the offshore banking unit will pay tax on the income which is earned by it. And again, when it distributes the income to the unit holders, that is where the holders were also being subject to tax. Just to, bridge this anomaly of double taxation, the budget now clarifies that if the offshore banking unit is already subject to tax on the income which is earned by it on the underlying investments, then on the income which is distributed by this OBUs will again not be subject to tax in the hands of the unit holders, and it will be exempt for the unit holders. These offshore derivative units are more popularly known as P-notes. And that is where the whole debate has now spurred, that do we see the P-notes being now, given credit to and being legalized by the government. So this was all the changes on the GIFT City IFSC regulations. I think the next is something which Saurabh sir has very eloquently discussed, which is onto the limits which are there for the presumptive taxation. And then there is an increase in the limits to cover more and more businesses into the presumptive taxation and give benefit to those small, medium enterprises. And there is a revision for access to presumptive taxation beneficial regime from a business which has a turnover of 2 crores to a business which now has, even up to 3 crores will be able to get the benefit of presumptive taxation. And this will be depending, on the fact that the cash receipts on the business does not exceed 5% of the turnover. There is a similar increase in the limits with respect to for professionals, wherein the limit has been increased from 50 lakhs to 75 lakhs, with a similar caveat for 5% of cash transactions. Since this would be under presumptive taxation, obviously they'll also be out of the purview of tax audit applicable under Section 44AB. The next is more sort of an anti-abuse provision, which is applicable to companies which are either, foreign companies which are into civil construction of turnkey projects or for oil exploration businesses in India, wherein they had the benefit of availing presumptive taxation. What was seen was that in the year of loss, they would go under the normal taxation, normal tax regime. And when they opted for a presumptive tax regime, they would set off the loss which was as such available to them under the normal tax. And that is where, to kind of curb this anomaly into, this is brought as an anti-abuse provision, that if you are opting for a presumptive tax regime, there would not be any set-off of unabsorbed depreciation or brought forward loss available to such businesses. The next slide will be on MSME and startups. Again, for MSME, there is Section 43B, which is introduced to benefit the MSME. And this is more with an intention, as what the finance minister says, to facilitate cash flows and business for the MSME, wherein if a payment is made to MSME, it will be allowed as a deduction to the payer on an accrual basis only if the payment is made within the timeline which is prescribed under the MSME Act. What we understand that the timeline is there's a stipulated timeline of 15 days, which can be then extended to 45 days under the contract, and the default time is for 15 days. If you don't pay within the said timeline, then the payment will be allowed to the payer in the year in which the actual payment has been made. Also, there's no benefit which is otherwise available under the 43B provisions, say for PF and ESIC and payments like, which says that if you make a payment before the due date of filing of return, then also the deduction has been allowed in the year in which it is accrued. However, such benefit is not available when you make a payment to an MSME, and hence, if you're making a payment, it's now become very necessary to first say whether the small organization that you're dealing with is registered under the MSME Act or not, and whether the provisions apply to them as well. We've just illustrated a very, brief illustration based on timelines. So for example, if the date of invoice is 31st of March, 2023, and the due date of payment under the MSME Act was 14th of May, 24, the actual payment happened within the due date, which is it happened on 10th May, before the 14th May, and hence it is within the time limit prescribed. So you will get as a deduction in FY 23-24, and so it's on accrual basis. But similarly, if the date of invoice is on 24 and the actual payment happened on 20th of May, which is in the financial year 24-25, and it crossed the due date for payment as per the MSMED Act, then it will be applicable in the year in which the payment is made. So the deduction will be in the year in which the payment is made, which is in FY 24-25. As rightly pointed out by Sir, this is only applicable to payment made to micro and small enterprises and not to medium enterprises. So there's a category of micro, small, and medium enterprises. The benefit is extended only to micro and small enterprises. The next is the proposal for startups. So startups have been now, recognized even by the finance minister as one of the growth accelerators of the country. And that is where, to give a little more of benefit to the startups, there is an extension for the tax holiday which the startups enjoy. So typically, if you are a startup, which you are a registered startup under the income, as per the category under the Income Tax Act, that means you also require registration under the Inter-Ministerial Board. And if you are an eligible startup, which is defined to mean something which you are into business which is innovative and generates employment, etc., then you get a benefit of 100% of tax exemption for 3 years, from the first 10 years of incorporation. So for the first 10 years of incorporation, the startup has an option to choose for the 3 years within which they can claim 100% of taxes as not taxable. It's a tax holiday which is granted to startups. This was available to startups which started or which were incorporated before 1st April 24, which is by 31st of March 23. This window is now extended to for 1 year, which is now you can be incorporated before 31st of March 24. Similarly, Section 79 of the Income Tax Act kind of restricts the benefit of carry forward and set off of losses for closely held companies if there is a change in shareholding for more than 51% during the year. However, there is an exemption which is given to startups. So if there is a change in shareholding for the startups, the startups are still eligible to carry forward and set off the losses which they have accumulated, subject to satisfaction of certain conditions. This loss carry forward and setup was available for the first 7 years of their incorporation. Now this from 7 years, it has been extended to the loss being available from beginning to from their incorporation to 10 years of their incorporation. So now if there's a startup which, even though there is a change in shareholding and it has accumulated losses up to say 10 years, even though there's a change in shareholding, the startup would be able to set off for the first 10 years in the year in which they attempt to set it off. Vishal, you would like to take for capital gains and onwards?
Yes, thanks a lot, Zeel. And let me take it from here. And one of the most talked about provision is on the capital gain. And first, let's look at the market linked debenture. So what the budget proposal has done is they are introducing a new section 50 capital A, double capital A. And they want to kind of curb the tax planning which was available till date on the market linked debenture. This of course is applicable from the next year. So there is no change in position, at least at the end of this current financial year. What used to happen was I as an investor would invest into, let's say, a listed market linked debenture. And it's instead of earning interest income, I would typically transfer that debenture at some point of time. Let's say after a period of 1 year, I would take a view that this is transfer of a long-term capital asset. This is transfer of a listed market linked debenture. And hence, whatever incremental income I have earned, I will basically pay a capital gains tax at 10%. So as an HNI, this was very attractive for me because effectively I would not be paying any tax on the interest income, but rather I would be paying a tax on the capital gain. And there were a lot of products which were being sold like hotcakes purely on the basis of this tax arbitrage. The government has apparently, I would say, detected some of these planning opportunities, and to really curb this kind of opportunity to pay tax at 10%, the government has brought a new section. What does the new section says which applies from next year? First of all, it applies to all kind of market linked debentures. The market linked debentures can be listed or it could be unlisted. It could be regulated by a regulator such as SEBI, or it could be a pure unregulated market linked debenture. It doesn't matter. Second is they've defined the market linked debenture. It means that it's any security which basically has an underlying principal component in the form of a debt, number one. So it can't be shares. And second, the return on this security is basically linked to an external index, an index, a ETF, a bunch of securities, whatever you want to call it. And moment a security satisfies these twin condition of it being a security where the principal component is a debt and the return is linked to some kind of an underlying security or some index or some external index, it will qualify as a market linked debenture. And how will the taxation happen? It says that the taxation in the form of capital gain will be deemed to be a short-term capital gain. And moment it's a short-term capital gain, you do not get benefit of the slab rate and you will have to pay taxes as per the applicable tax rates. So this is something which I would say is interesting. Then the popularity of the MLD instrument, as we used to call it, will now be purely be on merit rather than a tax arbitrage per se. So that's one significant budget proposal. If we were to look at a couple of other capital gains tax related proposal, I think any conversion of gold to electronic gold receipt and vice versa has been exempted, and this was a much needed clarification. And let me give an example. If I have a physical gold, I can approach a SEBI registered vault manager. I can surrender that physical gold, and in lieu of that, I would get what we call a EGR, electronic gold receipt, which technically is a security. From an income tax perspective, today, as we see, there is no exemption for this exchange of gold held by me, in lieu of which I received this electronic gold receipt. So this could be subject to a capital gains tax. And to kind of protect it, the government has come up with a simple budget proposal, which says that a conversion of physical gold into an electronic gold receipt would not be regarded as a transfer, and hence there would not be any capital gains tax. Also, the cost which we had incurred on purchasing that physical gold will be transferred to the gold receipt. Also, the period of holding for which I held the physical gold will be transferred to the EGR. So that's again a welcome move. It is of course applicable from next year. So if there is any conversion of physical gold into EGR into the current year, I think that continues to be, I would say, debatable, as to what is the tax, etc. The second interesting provision which has been brought about again from next year is cost of acquisition with regard to any intangible. And let me give an example to illustrate that. Suppose I have created, I'm a pharma company. I have created my own brands over a period of time. And at some stage, there is a new acquirer which says that I want to purchase your brands. Today, when I sell those brands to the acquirer, there is a very strong argument that no capital gains tax should be levied on that sale of the brand for two reasons. One is that brand is an internally created brand, and because that brand is internally created, I cannot compute the cost. And because I cannot compute the cost, relying on certain Supreme Court decisions such as BC Srinivas Shetty, etc., the charge of capital gains tax fails. To curb some of this potential tax planning, the budget proposals basically say that going forward, any such capital asset, including any intangible, etc., the cost of acquisition and the cost of improvement would be taken as nil. So the argument that you cannot compute the cost and hence the formula fails for computing a capital gain is no longer available. One challenge is the way they have worded it is a genuine cost spent on improvement on any intangible asset is also to be taken as nil, and which I think could be detrimental. Let's say I'm developing a molecule. A development of a molecule basically takes millions of dollars. I have developed the molecule till phase 1. Another acquirer comes, it acquires that molecule, and then it spends further amount to improve upon that molecule so that it is market ready. Now, all this cost which the new acquirer is kind of spending to improve this molecule, the budget proposal says any cost spent on improvement of such intangible asset would also be taken as nil. And I think this is unintended. And therefore, I'm expecting some kind of a representation being made to the government before this bill gets passed into law. But if this change doesn't happen, then it could impact many such companies which spend millions of dollars on improving intangible assets per se. The next change is, of course, not a very popular one, especially when it comes to HNIs. It is restricting the benefit under Section 54 and Section 54 capital F on capital gains tax planning by way of investment in a residential house. Today, if I have sold shares of my company worth, let's say 1,000 crores, I can actually invest the complete proceed and buy a bungalow in the Lutein area of Delhi, let's say worth 800 crore, and claim capital gains tax exemption to that extent per se. Or if I have one house which I have sold it for, let's say 100 crore, I can reinvest that proceed into another house, subject again to certain conditions, and claim exemption under 54. The budget proposals which apply from next year, it basically says now the maximum benefit which you can take is up to investment amount of rupees 10 crore. So you are allowed to buy a house of a larger denomination. It could be 50 crore, it could be 75 crore, it could be 25 crore. But for the purposes of tax exemption under section 54 and section 54F, the law will only consider an amount up to 10 crore of investment. So this is obviously going to, I would say, hit the luxury residential market, where significant investments used to come on the back of a tax exemption under 54 and 54F. What happens to those deals where, let's say, somebody has sold the shares, earned the capital gain in the current year, but not yet invested into a residential house, because you look at a period of 2 years of investment and 3 years if you're really constructing a house. I think prima facie it seems that if the capital gain has arisen in the current year, then there are no limits to the 54 and 54F planning. You can go and comply with the purchase of the residential house in the desired timeline, which is 2 or 3 years, depending on whether you are purchasing it or you are constructing it. And there would not be any limits applicable. But any capital gain which arises from the next financial year, you will see this limit of 10 crore being applied directly. With that, let's move to certain other anti-abuse provisions. This is a very, very interesting provision. Currently, as you are aware, we have this whole issue of angel tax coming in. And the law simply states that if an Indian company receives a share premium amount from domestic investors, then the share premium better be justified. And if the share premium is found to be in excess of the real market value, then that excess share premium is deemed to be the income of the Indian company, on which the Indian company has to pay a normative tax. This excluded certain categories of investors. For example, if you have a domestic AIF, a domestic registered fund under SEBI, etc., they don't qualify under this. And also, if you have a non-resident investor, then you don't have to justify the share premium. What the budget has proposed is that going forward, a non-resident investor would not be exempt from the applicability of this angel tax provision, which is enshrined under section 56 to 7B per se. Hence, any non-resident investor investing in an Indian company at a premium, the Indian company will have to now justify that share premium again through a valuation report, doing a DCF valuation, etc. So we expect that the controversy on angel tax is now going to be far expansive in scope, especially with regard to non-resident investor. And you can also have certain unintended scenarios. There's a foreign company, the foreign company is investing into the Indian company, which could be its wholly owned subsidiary. So it really doesn't matter at what value the investments happen. But now if the share premium at which the parent invests into its wholly owned Indian subsidiary is above the market value, or if it is held to be above the market value, then there could again be a tax exposure on the Indian company. So this is, of course, going to be, I would say, undesirable from a foreign investment perspective. The second anti-abuse provision which the government has introduced is an amendment under Section 9. So last year, we had an amendment where any gift paid to a non-resident person who does not fall under the relative definition was deemed to accrue in India, on which tax had to be discharged. So if I have a friend, let's say, staying in USA, and I gift him an amount of 1 lakh, and he doesn't fit under the relative definition, then the recipient, which is that US friend, has to file a return and discharge a tax under Section 56. The definition of a non-resident obviously doesn't include a not ordinary resident. So the current year's budget proposals now extend this tax even to a not ordinary resident non-relative, to a not ordinary resident non-relative, and which also means that if I have somebody staying in Dubai, let's say, who technically has become a not ordinary resident by virtue of his Indian citizenship and other provisions under Section 6, then any gift given to him could now even be captured under Section 9. The next provision deals with distribution by business trusts, which are basically REITs and InvITs. And this provision particularly intends to address a distribution by REITs and InvITs by way of repayment of loans. So if you look at the current provision, if REITs and InvITs, let's say, give a loan to certain companies, and those debtors basically pay back the loan back to the REITs and InvITs, and REITs and InvITs distribute that proceeds which have come via repayment of loan to the unit holders without necessarily redeeming the units. Then the current position seems to be that those distributions are not subject to any tax. Interestingly, subsequently, when there is a redemption of the units by these unit holders, there is no impact on the cost base of that. So this obviously is some kind of a double non-taxation, completely unintended. And therefore, what the proposal says that going forward, such distributions, which are neither interest, neither dividend, neither rental, which otherwise would have been taxable, they would now be taxable in the hands of the unit holder as income from other sources. So they have basically amended Section 56, which is basically a deemed benefit. They have also made certain consequential amendments in terms of redemption of units. For instance, if there is a payment which is towards redemption of units, then they are saying that these provisions will not apply to the extent the amount is equivalent or lesser than the amount invested in the units per se. So this is clearly a provision which has been brought in to avoid a double non-taxation. And this is again applicable from next year, which also creates a question that does it now imply that all these distributions of loan proceeds, which REITs and InvITs used to make to the unit holders, they continue to remain non-taxable because the provision which is now expressly making it taxable has now been brought from a futuristic date per se. There is, we all know that you have this manufacturing companies, pure manufacturing companies, which pay a concessional tax rate of 15%. Similar provisions have now been made applicable to manufacturing cooperative societies to bring them at par with manufacturing companies, where these manufacturing cooperative societies would now pay a 15%, subject to almost similar conditions which are applicable to pure manufacturing companies. So this again is applicable from next year. Certain changes proposed in the assessments, appeals, and dispute resolution related provision. The first provision is in the context of reassessment. Today, when a reassessment notice is issued and the taxpayer is directed to file a tax return, there is apparently no time limit prescribed under the Income Tax Act. And normally we would see that the notice would give a timeline of anywhere between 15 to 30 days. We now have a specific amendment which says that whenever you direct a taxpayer to file a return under Section 148 in the context of reassessment, then the timeline will be 3 months from the end of the month in which such notice is issued. So this is, of course, I would say a welcome clarification. First is that it gives enough time compared to the current practice of just giving 15 to 30 days. And second is there is a clarity as to within what time the return in case of reassessments need to be filed. You also have now an opportunity to request the assessing officer that kindly extend this time limit. So for certain reasons, if you're not able to file within 3 months, the assessee, the taxpayer, can file an application requesting the assessing officer to kind of extend this timeline. A very interesting proposal is in the context of introduction of a new authority, which is Joint Commissioner Appeals. And one of the reasons is that today, if you look at the maximum cases which are lying stagnant, they are basically at a Commissioner Appeals level. I think the government is trying to kind of implement the faceless Commissioner Appeals process, but I think they are still not been able to completely make it a big success. So for the last 2 years, you hardly have any commissioner appeals orders being passed. And because of that, there's a huge backlog which is lying at a commissioner appeals level. So the government has announced that we will create a new authority, which is Joint Commissioner Appeals, and we will come up with a particular scheme whereby certain small matters would be transferred to Joint Commissioner Appeals. This is basically to, I would say, relieve the pressure which is currently there at a Commissioner Appeals level. So we will await notification of that scheme in the coming weeks, and you will now have a scenario in the coming times where large matters are being heard by Commissioner Appeals, and certain small matters which qualify under the scheme, they are being heard by Joint Commissioner Appeals. And we do expect that the resolution of matters before Joint Commissioner Appeals hopefully would be far swifter going forward. You also have now a power given to the assessing officer to appoint a practicing cost accountant to kind of do a inventory valuation. Till now, the only powers were restricted, to direct a special audit, which was done by a chartered accountant. But now, of course, they can also get into a specific inventory valuation. These are just widening of their powers when they are doing any assessments. You also have certain changes in timelines. Basically, the timelines have been increased, let's say by 3 months. For example, if it's a regular assessment, then the current timeline is, you need to complete it within 9 months from the end of the relevant assessment year. That 9 month has now been basically made to be 12 months. So just as an illustration, for assessment year 20 to 23, the current timeline was 31st December 23, but it is now being extended to 31st March 24 per se. Similarly, where cases which involved an updated return which was furnished, you basically only had 9 months from the end of the financial year in which the updated return which is furnished needs to be assessed. That 9 months have again become 12 months. So again, taking an illustration, if there is an updated return filed for assessment year 22-23, and we have filed that in the month of, let's say, April 23, then instead of 31st December 24, the timeline is now increased to 31st March 2025. Similarly, in certain cases of assessment, reassessment, pending on the date of initiation of a search, we now have a timeline for completion of assessment or reassessment, which is being extended by 12 months in certain cases. So this is just to give some breather to the tax office, to comply with the deadlines. On transfer pricing, again, nothing very significant apart from 2 major changes. Today, whenever an assessment, transfer pricing assessment happens, typically there is a timeline of 30 days given to the taxpayer to file the transfer pricing documentation. There is a suspicion by the tax office that this transfer pricing documentation, which needs to be prepared in a contemporaneous manner, gets prepared only and only when the notice is issued per se. So to discourage those practices, they have reduced the timelines substantially from 30 days to 10 days, which effectively means that if you now have a notice, within 10 days, the assessee will have to file a TP documentation, which only means that he can't start preparing the documentation when the request is made. You also had, certain provisions of specified domestic transactions. For example, today, if an Indian company is availing a special rate of 15% on its manufacturing income, then it needs to justify that all its transactions with related party are in compliance with the transfer pricing provisions. The whole purpose is that they do not want the Indian company to book a higher income on which you are taking a concessional tax rate of 15%. The same provisions are now being applied to a manufacturing cooperative society, which will also now be able to get a concessional tax rate of 15%. One very important relaxation is to an NBFC. We do have thin cap regulations, in the Income Tax Act, whereby the interest payment to your non-resident related party is restricted basis certain formulas. Today, only banks and insurance companies are exempted from this onerous thin cap regulations. You now have from next year, even an NBFC being exempted, which I thought was a very welcome move. It was kind of represented for a long time that you cannot make NBFC, which is in the business of financing be subjected to a thin cap regulation. So this comes as a very, very welcome move from the government. Let's take very quickly on certain TDS provisions. We have a section 194B. Currently, section 194B is applicable to any lottery, crossword puzzle, card games, or any such winnings where there is a TDS of 30%. This now is going to be expanded to even include TDS on gambling or betting of any form per se. As I said, gambling, betting may be legal, may be illegal, but it does not, of course, matter from an income tax perspective. One will have to basically comply with the TDS provisions from next year. You also have this whole issue about the quantum on which TDS was applicable under 194B. There was an interpretation that this applies only if qua transaction the value is about 10,000. So if one were to basically get 3 tranches of 9,000 each, the view being taken was that TDS is not applicable because these transactions are less than 10,000. But now the section is being amended to say that we will look at the aggregate amount. So if the total aggregate amount exceeds 10,000, then on such excess, the TDS will need to be made applicable. This, of course, is going to be a bit more of an implementation challenge. So, somewhere the technology, etc., will have to be tightened per se. But this is clearly an anti-abuse where apparently the government thought that people are obviating this section by breaking their price incomes into smaller amounts. You now have this whole online games which are now last year we had TDS coming on the crypto transactions. This year we have TDS provisions coming on the online games transaction, and this again is applicable from 1st July 23, not from 1st April, but from 1st July 23. They are giving some time to all these online gaming providers to kind of create a robust system to comply with this. They are also saying that we will apply a TDS of 30% on net winnings. So it's not necessarily on a single transaction, but on the net winnings. And broadly, they are saying that whenever you do a withdrawal of your net winnings, you will apply this 30% on that. Alternatively, if the year ends and the money is still lying in the account, in the wallet of the online game service provider, then you will look at the net winnings in that account and apply the 30% on that. Of course, there is going to be a separate method of computation, which hopefully will be notified very soon as to how this is going to be calculated. But this is again, of course, going to put a lot of compliance burden on the online gaming companies, etc. And we are going to obviously see more and more such scenarios where the government tries to capture every source of income which is coming via this. One of the most controversial proposals is this TCS on overseas remittances. Last year, we had this provision where if somebody is transferring foreign currencies under the LRS, RBI Liberalized Remittance Scheme, and under certain circumstances, there was a 5% TCS on these amounts. And those 5% TCS has now been increased to 20%. And interestingly, it does not reduces your quantum of LRS remittances abroad. So today the annual limit of LRS is $250,000 per individual. I think they can continue doing that. But whenever they do that, there will be a higher amount of TCS, which the banks will have to collect and deposit it. So there will be a working capital issue because that TCS will then have to be taken as a credit in your return, which you will find after a year, hopefully. In this table, we have just summarized, the 4 instances which talks about the present rate and the proposed rate. Very quickly running through that, if let's say a student has availed a loan from a financial institution for pursuing overseas education, and you're remitting those loan amounts to basically, let's say, pay your university fees, etc., then the current rate is 0.5% in excess of 7 lakhs. There is no change in that. It continues as it is. The next is, there is no loan obtained from any financial institution, but there is some education remittances being made, or any remittances which is being made for medical treatment. Again, the current rate is 5% of the amount in excess of 7 lakhs. There is absolutely no change. It continues as it is. There are two more things which have been introduced by the budget proposals. If you are sending any money for any overseas tour, earlier it used to be 5% without any threshold limit. Now that 5% has become 20% without any threshold limit. And in any other case, there used to be a 7 lakh threshold limit and the amount of tax TCS was 5%. That threshold limit has been taken away and now it is 20% without any threshold limit for any other case. So you will see a larger tax being applied to remittances. And of course, you can claim a credit. It is only a timing issue, but this is going to be a working capital challenge. Couple of other TDS provisions. There has been some rationalization in terms of TDS. For instance, any employee who did not have a PAN and was withdrawing any taxable amount from the accumulated balances of Provident Fund, the law said that you basically have to apply the maximum marginal rate, which was 30% plus applicable surcharge. They have reduced that rate to 20%. So that's a small concession being given. You also had a kind of a TDS under 194, on any kind of a withdrawal of cash, beyond 1 crore. That limit is now being increased to 3 crore. So if a cooperative society is, let's say, withdrawing cash up to 3 crore, I think effectively they don't have to pay any. There is no TDS applicability on that. You also had this ambiguity as to whenever a mutual fund used to distribute to the non-resident, basically you were only applying the current income tax rates, the domestic tax rates, because it was under a specific section. The law now says that you can now apply for a lower tax residency certificate if a lower rate is applicable under the tax treaty, which effectively means that instead of applying 20%, if the non-resident investor says that, wait a minute, you're making this distribution, only 10% is applicable, then now that investor can apply for a lower TRC, basically, due to which the TDS will be reduced from 20 to 10%. This procedural benefit was not available before. You also have, ability that if there is a RIT or InVIT, which is distributing income again to non-residents, again, you can go and kind of obtain a certificate under 197 for a lower tax deduction certificate. So till now, if I am a non-resident, I am earning income from a RIT or an InVIT, the RIT or InVIT will kind of deduct tax at the applicable rates under the domestic tax law, which was, let's say, normally 20%. And then when I have to file a return, I have to say under the treaty, it's only 10%. So please give me my refund back of balance 10%. But now I might like to apply for a lower withholding certificate under the Income Tax Act, so that there is no requirement to kind of file a return just to claim the refund. You had this exemption from TDS on any interest paid to a resident on listed securities held in demat form. The government has now removed that restriction, and now you have a TDS rate at 10% under section 193. This is apparently to just track that people are paying their income taxes or not per se. You have certain TDS penalty related procedures which have been introduced in the context of compliance under 194R and 194S. 194R, as you are aware, talks about any benefit given to somebody in the course of business, and 194S talks about the crypto transactions, where again there is a TDS liability. So they are trying to make it more penalizing if somebody does not comply with the TDS obligations under 194R and 194S. In the context of business reorganization, last year we had a new section being introduced, 170 capital A, under which there was an ability by the successor to kind of file a revised return. So if, let's say, I am an existing company, I am demerging my business to a new resultant entity with retrospective effect. And if the successor entity had already filed a return, it could go back and it could now file a revised return. But there was no mention about the old company, because even the old company might require to file a revised return. So they have clarified on these procedural aspects, and they have now made enabling provisions whereby even the old company and the new company both can go and file revised returns. There are certain lacunas in the wordings, and we expect that those lacunas will be ironed out before the finance bill gets legislated as a finance act. But the intention is very clear, to cover all the entities which are covered in a scheme of merger, demerger, or any other kind of a business reorganization. Very quickly on the deductions, very interestingly, we have certain funds which are no longer eligible for ATG. They are Jawaharlal Nehru, they are Indira Gandhi, they are Rajiv Gandhi Foundation. I think the names are obvious, what's coming next. So now any payment to these funds would not be eligible for ATG. You have a kind of a new section being introduced, AT CCH, whereby any contribution made to the Agniveer Corpus Fund would be eligible for deduction by the individual, and in fact any parallel matching contribution made by the central government is also allowed as a deduction to that individual, which is a very interesting provision. The individual has not made those contribution, it's the contribution made by the central government to match the contribution, and yet the law says that those contributions shall be allowed as a deduction. This obviously seems to be a populist move to make the Agniveer scheme more popular and to find more takers. Very quickly, we'll talk about a few other amendments before I hand over to Chintan on the indirect tax. A very, very important amendment has been made under section 28, which says that any benefit, any perquisite in cash or in kind, or partly in cash and partly in kind, would now be regarded as a business income. I think this is a very far-reaching amendment, and it begs the question as to what happens when loans are written back, what happens when under IBC you get a permission to kind of write back certain payables, certain receivables. You have a Supreme Court decision of, let's say, Mahindra and Mahindra, which basically says that such write-backs are on in capital account and they are not necessarily taxable. But can this section basically reach out to that kind of a Supreme Court decision and negate that decision? I think time will say. And but this is something which, in my view, looks to be very, very innocuous, but a very dangerous provision. And one will have to really wait and watch and kind of look at every kind of a benefit, whether it is cash or in non-cash, to basically see whether this becomes taxable. I think there will be a lot of hue and cry, especially on the IBC side, to say that you have to come up with certain exceptions, or you are killing the whole IBC process. You are killing the whole one-time settlement process, between a bank and a borrower person. You also have section 10AA, which applies to SEZ units, where now they are making a law from next year, which says that deduction of tax holiday to an SEZ is allowable only and only if the proceeds from export of goods or services are brought within 6 months or within such other time as is eligible under FEMA provisions per se. These provisions were earlier only in the context of 10A and 10B. They were not in the context of SEZ, but they have basically kind of brought that provision also, which also means that an SEZ will have to be far more careful, far more practical to ensure that they get the dues well within time in the country. You do have this ongoing issue of a tax credit where you offer an income in year 1, but the TDS is deducted by the payer in year 2, and you find it as a challenge to get that as a credit. I think this is a welcome procedural window whereby a taxpayer which is offering an income in year 1, whose TDS is actually deducted in the second year, can actually apply to the tax office saying that, wait a minute, no tax has been deducted till date. I don't want to pay an advance tax because there is already a TDS in the next year. And please go and give me a credit. And you have an ability to file such a claim, such an application within 2 years from the end of the year in which tax is withheld. So it's pretty good because by the time your assessments are going on, there seems to be an ability to ensure that these credits are given. So this was creating a lot of procedural challenges for a scenario where the income and the year of tax deduction is not matching, but hopefully this should give some relief to the taxpayers per se. I think lastly, we have 2 more important provisions. One on online gaming. I did mention to you that there is a TDS provision which has been introduced. There is a corresponding tax charge provision which has been introduced, where they are going to tax your net winnings at a flat rate of 30%. Till now, if I'm getting any online game winnings, I will offer it to tax as per my slabs. But now they are proposing the highest rate, which is 30% plus surcharge and applicable cess. And lastly, the life insurance policies. And of course, you would have seen all the insurance stocks down. And this is everything to do with the endowment policies, whereby somebody could be kind of paying a significant premium with the hope of getting tax-free proceeds. So what is happening on the LIC front, if I have to just summarize and give you a picture, any keyman insurance policy taken by the company, when in future they receive proceeds, are generally taxable now. Second, you also had this ULIP, where the government made an amendment last year. ULIP is basically something where the mutual fund organization had objected, saying that people are investing via the ULIP route. You are taxing the proceeds from mutual funds. Why are you not taxing proceeds from ULIP, which is effectively an investment product? So last year, government said that if you are paying a premium of 2.5 lakhs or more under a ULIP product, even that becomes taxable. This year, the government wants to club any other kind of endowment policies which are issued on or after 1st April 23, where the premium paid is in excess of 5 lakhs, and where during the tenure of the policy or thereafter you will receive something. So it's the widest coverage, I would say, of such an LIC policy, where you receive something other than on the event of death. If somebody dies and there is a payment being made on a policy, those are exempt. But if somebody receives the proceeds while he's alive, and it is in context of a policy where you have paid a premium of more than 5 lakhs, then those proceeds become taxable. And in my personal opinion, this is a very, very logical provision which the government has brought, because the simple message the government is basically sending is that a life insurance cannot be for the purposes of investment. So any investment proceeds, investment income you are receiving, please pay taxes on that. And that's going to be, I would say, the case going forward per se. I think with this, I would hand over to Chintan, who would talk about the GST and customs proposal. Chintan, over to you.
Thanks, Vishal. The indirect tax proposals can broadly be divided into 3 categories. One is related to the legislative changes, which are for the trade facilitation measures. The second is related to streamlining of provisions related to compliances. And the third is related to rationalization of customs rate. And of course, there are no changes in the GST rates, because GST rates are no longer a part of a budget exercise. Coming to the GST proposal, the Schedule 3 of GST Acts provides for a list of transactions wherein certain transactions are kept out of the GST ambit. Of this, there are 3 transactions. One is the out-and-out sales, also known as the merchant trading sales. Second is the sale of warehouse goods, also known as in-bond sales. And the third is the high C sales. These transactions were kept out of the ambit of GST effective from 1st February 2019. Now, there are questions regarding the taxability of this transaction for the period prior to February 2019. Accordingly, the budget has redressed this issue and has come up with a retrospective amendment to state that these transactions will not be leviable to GST effective from July 2017. Now, if at all, if GST has been paid on this transaction for the given period, that amount would not be refunded. The next amendment is favorable for the people who are registered under the composition scheme. The composition scheme restricts a person from selling goods through e-commerce operator like, say, Amazon or Flipkart. The budget has proposed to remove this restriction so that the composition scheme taxpayers can supply the goods through these e-commerce operator, and thereby providing an ease of doing business for them. The next amendment is regarding the place of supply for transportation of goods carried out for domestic customers. Presently, there is a provision in the place of supply provisions which states that the place of supply would be considered as outside India if the goods are exported. However, the service is provided to the domestic customer. This created issues like whether the transaction should be considered as an intrastate supply or interstate supply, as well as there was also a question on the eligibility of ITC on the recipient. To remove this issue, the budget has now proposed to delete the provision. And to simplify this, the place of supply would now, for the registered person, would be the location of that person. And if it is not a registered person, then the place of supply would be the place where the goods are handed over. The next amendment is regarding the retrospective applicability of Section 23. Now, under GST law, there are basically 3 sections which govern the GST registration. There is Section 22, which provides for voluntary registration or when it crosses the threshold limit. There is Section 24, which provides for a mandatory registration irrespective of the threshold limit. For example, a person is required to take a mandatory registration if it is getting any inward supplies which are liable to GST under RCM. Then there is this Section 23, which provides that a person who is exclusively into providing exempt or non-taxable supply, he is not required to take a GST registration. Now, there is an anomaly in the law as to which section would prevail in case of a conflict. Let's say a conflict between Section 23 or 24. Now, the budget has proposed to take away the anomaly to state that Section 23 would override Section 22 and 24. With this anomaly would get resolved. If we can move to the next slide. Yeah. A substantial amendment has been made in the definition of OIDA services. To give you a brief background, the taxability of OIDA services is relevant to a service provider which is outside India, and such services are provided to a recipient in India. Now, typically, if such services are provided to a person who is registered under GST law, the GST liability falls upon that recipient and he has to discharge GST under RCM. However, if the recipient is an unregistered person, the onus of discharging such GST liability falls upon the foreign service provider. An important thing to note over here is that one of the conditions to qualify as an OIDA services is that it must be essentially automated and involving minimal human intervention. Now, this phrases essentially automated and minimal human intervention, these have not been defined in the GST law, and accordingly, this is a matter of dispute as of now as to what qualifies as essentially automated and what is minimal human intervention. To do away with such disputes, the budget has proposed to delete this line. While the objective behind such deletion was to reduce the dispute, however, this deletion essentially opens up a Pandora's box of litigation, since the definition now becomes very broad to include any services delivered over the internet. So, for example, let's say this webinar was being broadcasted by a foreign service provider and there was a consideration being charged. One could say that this is a service qualified as an OIDA services, and GST could be leviable. One can expect some kind of a clarification to be issued by CBIC once the provisions are made effective. These are welcoming measures provided in this budget, which are regarding the decriminalization of offenses and the reduction in the compounding amount. Now, the offenses related to obstruction of an officer, tampering the evidences, not providing or providing false information, etc., are no longer an offense under the GST. Also, the threshold for prosecution of a person has been raised from 1 crore to 2 crores. Of course, this does not apply to the offenses which are related to fake invoicing. Similarly, for compounding of an offense, presently the compounding amount ranges from a minimum of 50% of the tax amount to a maximum of 150% of the tax amount. This has now been proposed to reduce to a range of 25% to 100%. Yes. The next proposals are pertaining to ITC. An important amendment which is applicable to the corporates. The proposal is to disallow the input tax credit of of GST on the expenses which are related to CSR expenses, which are mandated under the Companies Act. Now, under Income Tax Act, such CSR expenses are not allowed as a business expense. And to align with the Income Tax Act, the GST law also has now proposed to disallow the ITC of such CSR expenses. Now, whether the ITC of CSR expenses is available or not has always been a debate since the introduction of GST law. And in fact, it was also disputed under the erstwhile service tax law. In fact, there are contradictory advance ruling under GST on this matter, wherein one set of ruling allows the ITC and the other disallows. Hopefully, with this amendment, this controversy would be put to a rest prospectively. In fact, this also opens an option to explore the possibility of availing the ITC of CSR expenses for the past period, for those who have not availed the ITC. The next amendment is related to inclusion of the value of inbound sales for the computation of exempt value. Till now, there was no ITC reversal, which is related to the supply of inbound sale, but now this would attract ITC reversal. Sorry, if we can move to the previous. Yeah. Certain amendments related to streamlining of the compliance provision. Till now, there had not been any outer time limit for filing GST returns. This budget has now proposed an outer time limit of 3 years for various returns like GSTR 199C, etc. These amendments are in line with the recommendation of the GST Council, recent GST Council meeting. The next amendment is regarding the interest on refund to be given by the department. Typically, the refund is provided from the 61st day of the filing of refund application till the date when the refund is actually provided. The budget has now inserted an enabling provision whereby the manner of computation could be prescribed by the rules. Next slide, please. Yes. This is a very interesting and important provision which has been inserted by section 158A, which provides for consent-based sharing of information by GST portal with other system. The information to be shared of the supplier or recipient would be of what is uploaded in the GST return, what has been provided in the GST registration application, the data which goes for generation of e-invoicing, e-way bill, and so on. Now, the data is to be shared with the other system, but the budget has not defined what other systems is, or neither any notification has been issued in this regard. But it seems that such other system is basically a non-governmental organization or an agency. One example of such other system could be TREDS, which is a trade receivable discounting system, which is a platform facilitating a discounting of invoices and bill of exchange. So let's say if this provision is implemented in data sharing is done, TREDS could directly fetch the invoice detail from the GST portal and undertake the further process of bill discounting. This would substantially save the time for the people who wish to go for a bill discounting, and this would apply to other commercial functions as well. It is important to note that this information could be shared only if the supplier or the recipient gives a consent. And of course, this comes with a caveat that if at all any consequences arise on account of sharing of data, the government or the GST portal would not be responsible. On the customs side, apart from rate changes, there are few legislative changes. One of them is amendment in section 25(4)(a). This provision was inserted in 2021, which stated that all conditional exemption would be valid for a period of 2 years from the date of new exemption. This provision was introduced with the aim of eliminating outdated exemption and introducing new exemption with a limited validity. Now, there were doubts as to whether this sunset clause of 2 years would apply to exemption provided on account of a free trade agreement or on account of some schemes under foreign trade policy and so on. To remove these doubts, a proviso has been inserted in this budget to specify that the sunset clause of 2 years will not apply to the categories which are mentioned on the screen. The other amendment is related to a time limit for passing an order by the Settlement Commission. As of now, there is no time limit provided, but now the budget has proposed a time limit of 9 months, which can be further extended by 3 months. And let's say in a scenario where after the extended time limit, the order is not passed, the proceeding would get abated and the adjudicating authority has to pass an order as per the provisions of the Customs Act. Lastly, a minor amendment has been made in the CST Act to provide that the disputes under the CST Act will not now be handled by CSTAT, which is an appellate authority under the Customs Act, instead of the Central Sales Tax Appellate Authority, since this Central Sales Tax Appellate Authority is now being abolished. Any pending proceedings in this regard shall now stand transferred to CSTAT. And with this, this wraps up the presentation on the budget proposals. Over to you, Vishal, for any further discussions.
Yeah, thanks a lot, Chintan. And we now have, the concluding session. We should conclude in the next 5 to 10 minutes, and we have few questions on the Q&A box. And very briefly, let me see if we are able to take up one by one. I think the first question is why benefit of 87A not taken in scenario 1? I think it refers zeal to our personal tax illustration.
Yes, Vishal, just to clarify, I believe the benefit of 87 is taken, but the extended benefit for 7 lakhs is only available in the new regime. So it's not available for the old regime. There was, I also believe, a follow-on question which said that whether the surcharge rate of 37% being reduced to 25% would be available only in the new regime or also in the old one. Here also the benefit is only available to the persons who are opting for the new regime. So if you're in the old regime, we believe the surcharge rate would still continue to be 37%.
Okay. Does the micro and small enterprises needed to be a registered unit? I believe there is some registration under the MSME, which is required.
Yes. So under, I think, Vishal, there is a section 7 and 8 of the MSME Act, which kind of requires the registration. Although we'll be reading the fine print to say that whether the Income Tax Act only refers to the qualification as a definition, or even the enterprises which are registered as such under the MSME Act. So the section also, kind of defines of which will be considered to be small and micro. And that just needs to be then ironed out in the fine.
Right. I think there is a comment by Deepak Bhai saying that for 44AD retail firms having turnover above 1 crore and below 2 crore, having cash receipts of more than 5% shall have to get their accounts audited. That seems to be a hardship, but it is so, right?
I will clarify, Vishal, but I think since he's under the 2 crore limit, the rate should be different of, the 6% versus the 8%, but the tax audit should not apply.
No. If he is paying tax on income at 8% or 6% or more, no need. It's only if it is below 8% or 6%, as the case may be, then tax audit would be compulsory.
Right. I think the next question is, can you please elaborate what is the difference between MLDs and debt mutual fund? Debt mutual fund obviously invest directly into the debts, whereas an MLD will be linked to certain market returns. So they are more like a derivative structured. Would you want to add something? Saurabh, any thoughts from your side?
I think, Vishal, yes, that will be the
that's
case.
correct.
Right. Me also. I think the next question is, we have received consideration for issue of shares from non-resident JV partner, which is in excess of fair value, and accordingly excess amount will now be taxed. What is transfer pricing implication with respect to issue of shares to non-resident JV partner does this excess amount considered as a loan and secondary adjustment is required to be made? I think, of course, these questions are more in the context of new law, I'm presuming. And because in the current law, the argument would be that these amounts are not taxable. And two comments. If this amount is regarded as taxable under Section 52, even from a transfer pricing perspective, I think one will have to justify as to whether the share premium is at arm's length or not. And if the share premium is not at arm's length, then the consequential impact is that there is a higher amount which has come in, and that higher amount gets taxed under 56(2). The question is whether this secondary adjustment is something which will be applicable. My prima facie view is it should not be applicable. It is a reverse transaction. So the provisions which are put in the context of secondary adjustment, where you need to bring the amount back, may not apply here in this case per se. I don't know, any thoughts from anybody on this?
Agreed, Vishal. And this will only apply if, because if the consideration, the issue of shares, the timing needs to be seen, because the amendment provisions are applicable from 1st April 2023.
Yes. There is an interesting question from Milan Bhai that, we take two policies of premium of 4 lakhs. So they are not exceeding 5 lakh, and whether the proceeds are taxable. I think prima facie, the wordings seems to suggest that because in toto you are crossing it, because that was also the issue in the earlier ULIP related taxation, where the limit was 2.5 lakhs. And I think the way the current practice is to aggregate the total premium on all these policies, and then anything in excess of that threshold that is being considered. But I don't know, any thoughts, Zeel, Saurabh bhai? But prima facie, Milan bhai, it seems it is going to cross the threshold of 5 lakh.
I agree.
Yes.
The next question says, if in 44 AD, if the turnover is less than 1 crore and cash receipt is more than 5%, tax audit will now be applicable for such assessee.
Again, Vishal, I think if the person is below the 2 crore limit, and if it is opting for the presumptive tax and paying the tax at the rate of 8%, considering they have cash receipts, then the provisions of tax audit should not be applicable.
And which means that the fact that the cash receipt is more than 5% is irrelevant, because you have opted to be governed by.
Correct. So there are two differential rates, which is 6% and 8%, depending upon what is your turnover in check or cash. But if still we are following the 8% presumptive taxation, then the tax audit should not be applicable.
I think the next question is whether this deeming provision includes relatives. I think a conjoint reading of 9(1) read with 56 will exempt relatives.
Yes.
So if really your recipient who's a not ordinary resident is a relative, then it would not be subject to tax. So that's a straight one. Let me first take anything which is relating to income tax act, since Saurabh has to leave. We have last question on corporate tax, which says whether 43B also apply on provisions made on 31st March for MSME. And the answer is yes, Zeel. All claim in the context of payments to MSME would have to be evaluated under 43B.
Correct.
Let me elaborate.
Vishal,
If the bill is received at the fag end of the year, let's say on 20th of March, payment was not even due by the end of the year, 31st March, then non-payment will not result into disallowance. But if the payment is received at a time when, after considering the credit period, the due date is before 31st March, on or before 31st March, and you have not cleared, then even though you have made provision, it will be disallowed. So maybe bills received at the end of the month, at the end of the year, which are not overdue, by the end of the year will be saved. Barring that, nothing will be saved.
Right.
Thank you very much. If I can be permitted to leave, because I need to go to a doctor.
So thanks a lot, sir. Many thanks, sir.
Thank you.
thank you, sir.
Chintan, we have a couple of questions in the context of indirect tax, and would you like to take one by one?
Sure, Vishal. I think the first question is that even if, let's say, there is a RCM under section 9(3), and pursuant to the amended section 23, can someone take a position that registration is not required. My prima facie answer is yes. I think the objective over here is to do away with such situations. So yeah, I think it should be a good case. The second question is whether ITC of CSR activities for financial year 2022-23 can be availed till November 23, even if bill is passed. I think the first point I would like to make over here is the provisions would be made effective from a date to be notified. So even if, let's say, this bill becomes a Finance Act, the provisions will apply from a future date, which may even take around 1 year or so. So yes, till that time, it's possible to take the ITC. But of course, this would attract litigation, since department is taking a stand that this is not for the business of the SSC.
Right. And I think the last question is there any limit for appointment of cost accountant? I think the Act doesn't provide so, prima facie, and maybe we'll have to wait and watch. Are there any instructions coming from CBDT? But today, this seems to be a generic power which has been given to the tax office to really take help of a cost accountant in any inventory valuation per se. So I think we have no other questions. Okay. So why don't I maybe do the closing ceremony, and thanks a lot to everybody. What we will be doing it is that all the participants who have attended, they will get a copy of our presentation latest by Monday. And if you have any queries, feel free to reach out to your contact in Aurtus Consulting. And once again, we hope you have found this budget presentation useful. Of course, there's a lot which needs to be further analyzed. We are still going through the fine print, and I'm sure as we go ahead, we'll keep on coming up with some interesting angles. So thanks a lot once again, and good evening to everybody, and have a great dinner. Yeah, thanks a lot. So we consider this webinar closed, and we'll be concluding our webinar. Thank you.